Hey folks, we're back with your favorite weekend show, Smart Money. Now on today's episode, we talk about a few secrets of wealth creation, how to build wealth over years using a few easy tricks of the trade. I have with me two gentlemen who have between them perhaps over 35 years of experience in investment management. They'll help us over the next half an hour with some ideas for creating a good, strong long-term portfolio and helping you achieve financial independence. We have with us today Charandeep Singh and Varun Daga, the co-founders and fund managers at Girik Capital. Gentlemen, thank you for joining us on the show. Charandeep, Varun, welcome to Smart Money. Charandeep, I want to start with you. You know, this is a very interesting situation in the market, right? Because on one hand, we have plenty of worries, whether it's the impending recession, whether it's inflation, the COVID situation across China, the shutdown in factories, etc. But on the other hand, the market is just 4% away from an all-time high. How are you feeling about the current situation?
Thank you for having us on the show, Sonia. That's a lot of questions. But before I start, I tell you, thank God it's Friday.
Always, always, absolutely.
Okay, so let's kick it off with that. How are we feeling about the current situation is, you know, let's use data to put this a little bit into perspective. You know, there's always macro noise going on in the world. You know, you've been in markets for long, we've been in markets for long. The Nifty in the last 12 or 13 years, since we started Girik, has had about 7 to 8 corrections of more than 10%, roughly. And you know, all those were always accompanied by some kind of noise, whether it was political noise, whether it was oil going to 100 or beyond, whether it was a war somewhere, or Portugal going bankrupt, or Spain going bankrupt, or Europe going bankrupt. There have been many reasons, and you know, markets always come back because the market is comprised of the best 50 companies or the largest, strongest, best funded 50 odd companies or top 100 companies. And they generally do well. Their profits have grown irrespective of what's happened in the country or in the world. Right? So
Absolutely.
I think that is what my answer to that question would be.
Okay, well, Varun is also with us on the show. And I mean, you know, I should tell our viewers that Varun and me go back a long way, right? We studied in the same college. We were both in Narsimonji and we graduated from there. And of course, since then, Varun, you've had this absolutely fabulous trajectory. You started Girik Capital. How has your journey been so far? I mean, of course, the Nifty has really sort of taken off in the last 8 to 10 years. And long-term wealth creation, it's not that easy. So we're going to talk about that in a bit. But you tell us a little bit about your own journey.
Oh, Sonia, I mean, we've both come a long way. I remember college days. Been a phenomenal journey. I think what we've seen how India has grown over the past 10, 12 years has just been amazing. And I think the country is so well staged for the next decade or two. So, you know, one great learning has been that, you know, when you see corrections of 10%, 15%, you know, earlier, of course, one used to worry a lot, but I think we've seen this over and over again. This is probably the 7th or 8th time, like Charandeep said. So, you know, one really has to look at the big picture, look at the long-term picture. There are so many new winners that are emerging. There are so many new companies that are getting IPO'd. Profit pools are increasing. You know, I think when we started, there were only a handful of companies making 100 crore plus profit. Today, there are hundreds of them. And I think when that happens, you know, you can hire great people. You can put technology. You can fight the world. You can do large capexes. You know, for the first time, India is seeing huge capexes happening. So which is great. So I think India has come a long way, and I'm so grateful that I've been part of this journey. And when you said 35 years of combined experience, I thought everybody must be thinking they'll see some 80-year-olds on the screen. But
it's true, right? I mean, it's true. Whatever you have so many years together, put together. I mean, 3 of us, we've been in the market for what, 50 years combined, if you look at it, right? So we have something to offer, of course. But let's start talking about the secrets of wealth creation, because that's what we want to sort of teach our viewers or share with our viewers, right? Now, the first secret, Varun, and we've spoken about this in the past, is that stick with with the leaders, not the laggards. Now, this sounds very simplistic, right? That always keep it with the market leaders. But there is this constant temptation of buying stocks that have fallen, say, 30%, 40% in any sector. How do you resist that?
Yeah, I think that's a very, very valid secret, and we all know it. But the temptation, our feelings, our emotions always creep in. And I guess the real secret about the market is how you can control your greed, fear, your emotions, your ego, and that's why this sticking to the leader always comes in, because buying a laggard or buying a third, fourth, fifth guy, hoping that will become a leader in the future, is very, very tempting. And the leader always looks expensive. People always feel, oh, the story is overdone, it's already finished. But the leaders always keep coming back. And, we will use a few examples in the show. We are not recommending any of them, but it's just for example purposes. We've seen companies like HDFC Bank, where, it's such a big leader. And leader doesn't mean the largest company in the industry. It has been a leader even when it was small. Leader means that, a company which has great management, which is growing very fast, has leading metrics. The customers are very happy with them. DMart is another example. I remember when DMart got listed, everybody said it's very, very expensive, 60p, how will it do well? And look what's happened. Many people bought future retail thinking that that's cheaper and it'll do better. But I think sticking with the leader always pays off. It could sometimes take a little longer, but a leader manages to grow. It manages to stay in that position as long as the leadership remains intact, and which is important. One needs to be careful and be cognizant of the leadership remaining intact. If it is intact, then one must stick to the leader rather than going to the third, fourth, fifth guy.
And this is a very important lesson, Varun, because wealth creation sometimes tends to get boring, right? I mean, what's the fun in buying an HDFC Bank and just holding on to it for long term, right? When you can sort of buy a Yes Bank and you can see it rise about 20% one day. So it's not as exciting, and that's why perhaps people veer towards the Yes Banks of the world, the GMR Infras of the world. Charandeep, come in on this, because the most questions that we get asked on social media: should I buy a Yes Bank after 20% fall? Should I buy a Vodafone Idea after 10% fall? But as easy as this maxim is of sticking with the leaders, people don't generally do it. Why is that?
Yeah, great point. That point you made about low price stocks is such a regular trap in the mindset of many investors or emerging investors. In fact, I was sitting with somebody yesterday. He told me, like, I have these many rupees. Can you get me the best low price stocks? Anything under 20 rupees will do. So I got a little worried when I heard that. And I told him, I said, listen, be a little careful. This is your money, hard-earned money. Don't mess around, But I think it's sorry. Yeah, and your question was, Sonia, could you just repeat your question?
No, my question was that, what is the way out of it? Do you completely stay away from these beaten down names, or do you still look for opportunities here? I mean, sticking with the leaders tends to get a bit boring sometimes. So what is the way out of it?
There's no way out of it. I mean, you must, I tell you what one can do if one wants to play around a little, have buckets, but don't deviate from having majority of your money in the leaders. Because, this is something, the elders have always told us, buy the best property or buy the best stocks or the best blue chips. At least have majority of your portfolio in it. People like to play around in markets. Markets are exciting beasts. So keep maybe 10% of your money for, outlier growth kind of stocks, which could just maybe give you a 100 bagger. I mean, if you're lucky.
Okay.
Or some for trading, but bucket it. I think that's the way to do it. The way out of it is to keep discipline.
Okay, so that's the first secret we spoke about. Stick with only the leaders, leave the laggards behind. The second secret of wealth creation, and Varun, I want you to come in on this one. There's a dramatic shift in the top 10 stocks of the Nifty. If you compare it to, the weightage that you had way back in, say, 2007, the top 10 stocks, you had a lot of these infrastructure names, a lot of these oil and gas names. Now things have changed a lot. There's IT, there's banking. But how do you use that while creating your portfolio?
Yeah, so again, there is a lot of recency biases in investors' mind, and why we use some of the stocks of the Nifty. We wanted to show that even a index like Nifty, which is actually an automated index, changes its allocation from one stock to another. So, like we saw in 2007, you had companies like ONGC, which was one of the largest holding of the index. You had companies like NTPC, Reliance Communication, BHEL, SAIL. Some of these were large holdings of the index. And if you saw over time, the leadership started changing. So, you have to also be careful where the leadership is changing. And you got to be agile, like how an index is actually very passive, but it's also active in a way where it says, okay, now I've got a Lagarde in my portfolio. So the point here is that every portfolio is going to have leaders and a Lagarde. Many times when you buy a stock, obviously you feel that you're going into a leader. But over time, you realize that, okay, this is not a leader. It's actually not performing for me. It's not working. I've waited 1 year, 2 year, 3 year, 4 year, 5 years. It's not working for me. So one needs to realize and move out. And that's why we gave an example of the index. The index does it, it will slowly wean out. It never averages its losers, right? It never buys more of the same. It will throw out the losers and it'll slowly start changing and moving into the winners. So the idea is that like the index does it, you must also be careful that the leadership can change and you might need to change your portfolio accordingly. And the great way to do that is look, once you've invested, look after a year or 2 or 3, you might see a lot of losers in your portfolio. I think the mistake people make is they will sell the winners because they obviously, it's very tempting when a stock doubles and you want to sell it and book the profit. But people hold on to their losers because they want their price to come back, right? Want your price to come back because, it's an ego, right? You got to come over here. How can I make a loss?
And you got to cut the cord at some point, right? You can't get emotional with your stocks. You got to cut your losses. I guess that is also a big lesson.
Exactly.
But you fell into the trap. You said that index does all the work for you. It weeds out all the losers. Then don't you think one should stick to buying index funds rather than, buying mutual funds? I know this is a wrong question to ask investment managers like you because most of you don't favor index funds. But in any case, don't you think the best long-term strategy should be just put your money in index funds quietly? Varun?
No, I think it's look, if you're not if you're not a professional manager, I think it's a great idea. In fact, we talked about it earlier. What we love about index is that that even after 50 years, an index will survive. You, me, or great managers will survive or not, who knows, right? But an index will survive. So you don't have a survival risk here. What we love about the index is this, right? It keeps weaning out the losers and keeps adding the winners, like how HDFC Bank was 1.7% of the index. It took it all the way to 10%. It rode off the winner. So it's a great strategy, but I think individual managers can do better. I mean, if you look at our history, our index, like we've made about 10x for our investors over the last 12 years, 13 years, where the index is about 3.5x. So you can use similar strategy. You got to learn from the index. But I think an individual investor or a professional manager has a larger bucket to choose from. An index has 50 stocks. We have 500 stocks to choose from. So I think that's where we can score. But nevertheless, I think it's really tough to beat an index. And more it gets difficult. And I think for an individual retail investor, it's definitely a great idea to invest in index funds. I don't know, Charandeep, if you want to add it.
Yeah, sure. I mean, the index is the market. It's effectively the largest fund manager in India is the Nifty. So if you think about it like that, you've allocated to the largest fund manager and possibly the safest, most automated fund manager that's not even using its own brain. It's just following a process. I think as long as there's a manager who has discipline, who has process orientation, it's good. The other advantage, someone like ourselves or smaller funds have is we're not constrained by size. We're not managing 1 lakh crore or 2 lakh crore. We're managing much smaller amounts. We're able to be much more agile and straddle across market cap spectrums, which is a huge advantage that we have over the Nifty.
Charandeep, another secret which I think a lot of people know but don't want to admit is that this buy and hold strategy could be a suboptimal strategy, right? It seldom works. I mean, if you look at, say, stocks like HUL, ITC, if you bought them about 10 years ago, you would have barely made any money. But is that the way to look? Is that a blanket way to look at it?
This is a very broad discussion, and I think it's it's something we think about a lot. But what we've learned over time is that, look, if you want to be a buy and hold investor, you should really know what you're getting into and the price at which you're getting into it, right? Sonia, even leaders, like the greatest leaders, sometimes go through 10 years of zero returns. I mean, look at Sun Pharma from 2015 to now, there have been zero returns. Look at Hindustan Lever last decade, or last decade, sorry. Look at Reliance last decade, look at ITC. So there's so many even index stocks that go through this mayhem, right? So what does an investor do? What if they bought Sun Pharma 7 years ago? Why we're trying to highlight this is that for individual investors that are trying to stock pick, it's very hard to actually go out and do it unless you have done proper homework, right? So getting into Sun Pharma in 2015 may not have been a very good idea. Do you have the patience to hold on for 10 to 15 years to see returns? You have to ask yourself that question, right? Where managers like us come in, we have shorter term mandates. We look to make money over a 3 to 5 year period. So we are always trying various tools and tricks to try to maximize returns in the shortest possible time. And I think, that's really the point that we are trying to make, that buy and hold could be a suboptimal strategy. It not necessarily is a suboptimal strategy. It will work over 20 years, but do you have that time and patience?
But I mean, in a way, don't you feel that you're sort of contradicting yourself? Earlier, you did say that the problem that some people have is they want to book profits quickly. If a stock doubles, they go and book their profits. Yes. Isn't that a better thing then? I mean, because then if you're buying and holding, you're anyway not making so much money. So if you're seeing profits, you might as well take it off, right?
I mean, you have to balance all these things, Sonia. I think, you're right. There are a lot of contradictions in this. For example, the first point we made was stick to the leaders, right? Yeah. And, here we are saying that, buy and hold and the leaders may not work. So that is also contradictory. But I think the way you balance something like this is, first of all, you have the highest chance of not losing your shirt or not wiping your capital out by being in leaders, right? So if you're building a direct portfolio, you need to be 70 to 80% in leaders, whether it's small, large or mid. You're not going to get your capital wiped out. Right? Even if you don't make money for 10 years, you at least get your money back.
Capital preservation is something that there is even a strategy, right? I mean, in those 10 years, you would have perhaps seen a recession, perhaps seen a pandemic. At a time like that, you want to preserve your capital. All right, take your point. Another secret that I want to talk about, and Varun, I want you to come in on this. You said just like the index cuts the losers, so should you. Now, the Nifty has cut out a lot of losers in the past, right? So whether it's Unitech, Suzlon, Yes Bank, Vodafone Idea. But these were stocks that had at one point in time given you great returns. So what do you do? As soon as they move out of the index, do you sort of move them out of your portfolio? What's the best strategy?
So, Sonia, I think, like they say, you have to respect the price. And I think what index does beautifully, keeping the fundamentals on the side, it respects the price so well. I mean, if you go back and just imagine you had all these stocks in the index, you had Yes Bank, you had Unitech, Suzlon, the entire, Reliance Communication, Infra. I mean, a lot of these names, which many of them don't even exist today, were in the index back then. So I think what's very important is that, when they start becoming, and many times, once you've bought in, you start seeing losses in many of them, and they give you enough chance, I think most important is, even if it falls by 20%, 30%, and you've waited on it for 3 years, 4 years, 5 years, I think it's important. Everybody knew that the fundamentals are deteriorating, right? It was, the writing was on the wall, but I think it's our emotions which doesn't let us get out of that stock. Because you bought it at 100, how can I sell it at 50? Yeah. You know that the earnings are wiped out. many investors say, okay, I bought it at 100, now it's become 20, let me average down more.
Yes.
But I think that's a very, very bad strategy. The index doesn't do it. It actually threw out, so it became a loser even for the index. Suzlon was a loser for the index, after it started falling, but it started throwing it out. So even if you're late, it's okay. At least you're not blocking your capital in a loser, especially once you've recognized it's a loser, you know. And I think that's the difference between holding a great company for a long time versus holding a loser. I think most of the people can open their portfolio and would be able to tell that, oh, I got stuck in this stock or that stock. But I think taking that action of getting out of it, I think that is something what many people can't do. And trust me, if investors are able to get out of their losing positions, it feels so much lighter, and that capital can be used into putting into winners or putting into better quality stocks. So idea is that winners take care of themselves, losers never do. They keeps dragging your portfolio. And the idea is to cut your losers. And even if you are 50% right in your stock selection, and you're just able to manage, if you're able to manage to cut your losers and ride your winners, I think you will make a fortune.
Okay, very wise words. This whole list has come up, and I just want to get that list up back. The nifty stock exits, right? I mean, it's caused heartburn to so many investors in the past, whether it's Yes Bank, Vodafone Idea, Reliance Capital, and these are all companies that were in the nifty at one point in time, and now they've all exited. And it is, of course, a lot of people have, as Varun was saying, tried to average at lower levels, etc. But once you identify a loser, you just got to cut your losses. There's no other way out of it. All right, Varun and Charandeep, we've completely run out of time, but it was a really fun chat and a lot of wise words, a lot of lessons as well for long-term investment. So thank you so much for joining us, and wish you both very well. You've had an exceptional journey up until now. I hope and I wish you lots of luck and prosperity. Thanks, guys, for joining in.
Thank you.
Thank you. Thank you so much.
Okay, with that, it is a wrap on another edition of Smart Money. Thanks a lot for watching. Have a great weekend.